Okay, so which exercise would you like me to cover in terms of cash flow? I see you've got a few here. Um, this is the first page. I see exercise 8.2, 8.3, 8.4. Which one would you like me to do?
I mean, even if we just start from the top and see how far we get, I just want to
Okay,
see the first ones. I just want to see what the question is below this
yeah.
again. I think it just said prepare. What does it say there? Let me check. I've got it open here as well.
All right, while you're looking at that, I just want to open up some notes just to share with you some background. You said you covered cash flows recently, so it's still quite fresh. So
Yeah,
just to share with you some content in terms of cash flow and what cash flow deals with, just to give you almost like a small little crash course in terms of theory.
cool.
I'm just going to open up some notes that I have. I think cash flows is week 5 or 6. Let me just check. No, that's companies.
I think it's study unit 7.
Is that the next one then? Okay.
Yeah, I think so.
Yes, you're right. Okay, perfect. Okay, so just to give you a little bit of context, just so that you have the background, so when I do go through those examples with you, you just have a better understanding overall from a cash flow point of view. So, okay, these discussion questions I'm going to skip. I'm just going to focus on theory with regard to the actual disclosure. So, when you're doing a cash flow statement, it's disclosure. So, you need to be able to take the information that's presented in the actual question and you need to separate it into three separate categories. So you've got cash flow from operating activities, you've got cash flow from investing activities, and you've got cash flow from financing activities. So those are the three sections that you need to prepare in terms of cash flow statement. And those three sections show you where cash is utilized in the business. So operating would relate to day-to-day running of the business. So things like debtors and creditors, sales, dividends, tax. Those are all part of operations. Then you've got investing. Investing from a cash flow perspective, we're looking at buying long-term assets, investing in property, plant, and equipment. All right, or taking out long-term investments in shares or companies. So investing would be long-term, non-current asset investments, and it could also be sales as well. So if you're selling shares that you've bought for a certain period of time and it's considered a long-term investment, or you've sold or disposed of assets or liability assets in terms of vehicles, land and buildings, etc. That'll be part of investing. So when you're looking at cash flow, we're looking at either inflows or outflows, but related to a specific category of transaction. So either operating, investing, or the last one, financing. When you're looking at financing, you're looking at debt or equity. So debt would be raising capital through maybe an issue of bonds if we're looking at a company, or raising capital through maybe perhaps loans or even issuing shares. That will also be part of financing. All right, so if it's related to debt or equity in terms of raising capital for the business, that'll be seen as a financing activity. Right, so you've got those three categories. Then you need to either look at direct method or indirect. So there's two different methods that you can utilize when drawing up a cash flow statement. The first method is direct. Direct is a bit easier because you're basically going top down. When I say top down, you're looking at each line item on the actual trial balance and you're looking at the general ledger accounts for all of them and you're looking at all the different transactions that can arise in that particular business and you're determining whether there could be an inflow or an outflow from that particular line item. So when looking at the direct method, there's a specific template that you need to be familiar with. The template is as follows.
Yeah.
You've got cash receipts from customers, cash paid to suppliers and employees, and then you've got a subtotal, cash generated from operations. Right, and then after that, you've got all these separate line items: dividends, interest, received or paid, and then you've got distributions to owners. Right, these distributions to owners would be out of profit. So in other words, remember we're looking at operating activities. So if I'm looking at operating activities, if the business has made a profit and you've paid out a portion of that profit to the owners of the business, then that will be seen as a distribution. Okay. If it's a repayment of capital, so for example, let's say a owner has invested capital into the business, and then down the line, the owner wants to draw a certain amount of his capital that they've invested. That'll be seen as a repayment of capital. A repayment of capital won't be part of operating activities. It'll be part of financing activities because it relates to something different. Financing is raising capital or giving capital back to those financiers. So when looking at the direct or indirect method, we're focusing primarily on operating, and we're looking at anything that relates to the day-to-day running of the business. In other words, financial performance over the 12 months, looking primarily at your line items on the income statement, okay, the statement of comprehensive income. And then there could be proceeds from the sale of a financial asset, but again, it needs to be short term. Okay, so less than 12 months. Okay, then you've got indirect.
So just a quick question on
Yes.
that. When you say it's less than 12 months,
Short term.
proceeds from the sale of a financial asset, yeah. Like how, I'm just trying to think of a financial asset that would, I mean, you can't sell it over 2 years, for example. I think I'm just understanding.
Yeah, so a financial asset, for example, could be buying and selling financial instruments. So that would be a short-term sale of financial asset. That could be seen as operating, not investing. Investing would be
would a long-term say you. I'm just trying to understand proceeds of the sale of financial. If you give like a 3-year bond or something.
No. 3 years. That would be not less than 12 months.
Okay, that's what I'm just checking. If that's,
so a financial asset could be bought and sold over the short term. If it's over the short term, then it would be considered operating activities, not financing or investing.
Cool.
Investing is what we're looking at here. So investing will be long term. You'll see that on the other slide.
Okay, perfect.
Okay, all right. So you're not going to see those two. Those two don't come up often. Okay, those two come out of the textbook. I don't know if UNISA still prescribes the textbook. I have helped students more recently, and they told me that they took the textbook away. Before, students were given a prescribed textbook, and then they were given the study guide. Do you have a prescribed textbook or not?
Yeah, we've got a textbook. I just took an older one.
Okay, volume 2, hey?
The new one is just very expensive. Yeah, well, it's called, let me just get the exact name.
Yeah, it should be volume 2.
Volume 2, 6th edition.
Okay, yeah, that's good. Yeah, so if they're still prescribing that textbook, that's good, because for a certain amount of time they took that away. Looks like they've brought it back, which is a good thing.
Yeah, for 1601, for 1502, for whichever one it was, that's the prerequisite for 1601. That doesn't have a textbook, but they brought the textbook for this one.
Okay, yeah, so there used to be a textbook for all of them. So 1502 1502 or 1601, there was a textbook. So you had volume 1 and then you had volume 2. But yeah, I'm glad that they're still prescribing the textbook for this module, because if you look at the textbook will describe the disclosure in terms of the direct method.
It does, yeah, both actually. And then I did do the assessment because I get 2 attempts at it. So I did it so long before we sat now, just so I can look out for certain things. But they only asked on the indirect method. But I mean, it's important to know the direct just in case that comes up.
Yeah, you need to know both. In terms of assessment, I do suspect that they'll probably assess the indirect method purely because it's more difficult.
Yeah.
All right. The indirect method is more difficult in terms of disclosure, and that's probably why they'll assess it. Direct is easier because you're just going to be using T accounts to work out the bank amount that will represent either an amount that was received or paid.
Yeah.
Okay. All right. Then, just in terms of disclosure, if you've been asked to prepare the net cash flow from operating activities based on the indirect method, then that's a bottom-up approach. So when I say bottom-up, you're looking at the profit before tax, or the profit for the year, depending on what type of business you have. Okay, the reason why you're looking at before tax or or after tax, it's because of this tax paid. Okay, so you can't take off tax twice. If you've got profit after tax here, then you can't show tax paid here separately. When you're looking at disclosure, if you look at the template for the indirect method, based on the disclosure for cash flow statements, you do need to show certain line items separately here. And that's why you have to show profit before tax, because closed corporations and companies are taxed separately. When you're looking at a sole proprietor and a partnership, there's no separate tax there. Okay, the sole proprietor in terms of the owner is taxed separately, and the partners are taxed separately as a normal individual. There's no separate legal entity with income tax, and that's why you have before tax. So you just need to look at the question. It's probably going to be before tax. I don't think they'll give you a sole proprietor or a partnership, but they might. It is part of the different forms of ownership. And then your adjustments.
Yeah, okay, cool.
These adjustments relate to non-cash items, so income or expense line items, or increasing or decreasing line items in your current assets or your current liabilities. Right, so that would be adjustments that you'd have to provide for that would affect your profit before tax. Because remember, certain line items can be changed or can be altered, and they're altered because of the accrual system of accounting. Remember, when you're looking at cash flow, you're keeping it simple. You're looking at inflows and outflows. You're not worried about amounts that are incurred or amounts that are earned. Okay, when we're looking at the disclosure in terms of financial accounting, the accrual principle is relevant. Okay, when we're looking at disclosure in terms of profit and loss. When we're looking at cash flow, it's different. Here we're looking at inflows and outflows. Right, and that's why you're having to provide for those adjustments. Right, then you have the same sub heading, cash generated for operations. So it's the same as what we just saw on the previous page. Okay,
yeah.
Except here you had a limited amount of disclosure and you have more calculations. Okay, here you have one profit figure and then you have adjustments, but then you get to the same basic subtotal, the cash generated for operations. Then you're going to be providing for the same operating activities, okay, in terms of dividends, interest, tax, etc., and that will be disclosed as part of the operating activities for your particular business. All right, then just a note about investing. Okay, with investing, you can have lots and lots of different types of transactions. What you need to think about here is it long-term? And does it affect long-term assets? In other words, property, plant, and equipment. If I buy more property, plant, and equipment, that'll be seen as an outflow. If I sell property, plant, and equipment, that'll be an inflow. Okay, if I acquire more investments, that'll be seen as an outflow because I'm thinking about the cash flow. Does it make sense?
Yeah,
okay.
With you.
And then just a note about the last section. Financing is looking at debt or equity. All right, so if you've covered any of the financial management modules, you'll see debt and equity comes up a lot in terms of financing. Businesses can decide on whether to use more debt financing or equity financing. When looking at financing, you're looking at raising capital. That capital can come from the owner. If capital is coming from the owner, that will be an inflow in terms of cash flow. If you raise debt through long-term debt instruments, so debentures, loans, bonds, etc., you'll also be raising capital that will also be seen as an inflow. If you're repaying those loans, if you're repaying those long-term liabilities, then that'll be seen as an outflow. If you're repaying any of the owners from investing, so any repayments of long-term capital will be seen as an outflow. Again, it all depends on what's happening. Is it a distribution of profit or is it a repayment of capital? Does that make sense?
Yeah.
Okay.
Yeah, it does.
All right, so that's just basic crash course in terms of content theory. If we look at practical questions, exam technique is very important. So when you look at a question like this, you need to know what method you're required to use, direct or indirect. So, okay, the exercise continues on the next page. Okay, there's the required. Okay, the required says, prepare the cash flow statement for the year ended, complying with IFRS. Okay, there's
Can
the direct
I just want
method.
to check one thing, Anthony. Sorry, I see it is a partnership and I see it saying direct method. So can we scroll and maybe just look for something that's related to either company or CC, and
Here's a
maybe does the
CC.
indirect
This is
method.
direct as well.
Yeah, like the test I did was everything was indirect. So I'm just
Okay, that's
thinking,
fine. Number 3,
I'm sure I can.
here's close corporation, here's indirects.
Okay, awesome. Yeah,
Okay, so
maybe
we'll
we
do
could
3
if
then.
we
We'll
could do
start with
that,
3
that'd be great.
then.
Yeah, that's great.
Okay.
And then I've got like some other notes, but it'll be great if we get into this first. They asked some strange well, not strange questions, but there were questions where I needed to say what the profit before tax was, for example, and I maybe got a bit stuck in just trying to calculate the profit before tax.
Okay.
In one of the questions.
Yeah. All right. Let's see how
But
we
I mean,
go.
if we go through it, I'll get an idea. Yeah.
Yeah. Let's see how we go. Let's focus on the cash flow. At least then you've got this section covered, and then we can always look at other things if there's time. Okay.
Yeah, that'd be great.
All right. Okay. So we know that this is a CC. We know this is a indirect method question. So okay, we're going to have disclosure here. So cash flow okay, you're going to show the disclosure as we highlighted in those slides. So profit before tax, because this is a CC. Okay, then you're going to have your adjustments. Leave lines. That'll create the cash generated from operations.
Oops, sorry.
It's fine. And then obviously any other line items, so tax, dividends, etc. And then net cash flow from operating activities. Okay. All right, that's the one. Then you've got to copy paste cash flow from okay, let me just copy paste this as well. Okay, then you've got financing. And then you've got finance, or investing then financing. Actually, it doesn't matter which one goes first. I just wrote financing first. Okay, I'm just going to go back and
Good.
make this investing. Okay, but you need the 3 sections. Okay, and that's what it looks like, right, in terms of your statement. So this is just disclosure. So if this was a written question, so in the past, obviously, you need to test this on campus, not on campus, in an exam venue, and then they ask students to prepare the statements. Because this is done online and it's an assignment-based assessment, they might be asking you for different line items in the actual working. Right, but yeah, it's always a nice idea. If they give you a long question, maybe do the whole thing, because if you do the whole thing, you could even check that the operating, financing, investing tallies up to the cash flow movement in terms of your balances for cash flow, if they give that to you. All right, so we'll see what we have.
That is what they do. It's a question of like, it's 20 questions, and then they'll give you this.
Yeah.
And then that you'll need to answer a bunch of different questions about it. So that's perfect.
Yeah. So if they do that way, then maybe rather just do the whole thing, and then just go back and look at each question and answer each question separately based on the workings. And if your workings don't match up, you can maybe adjust certain things to see if you can get closer to the right answer.
Yeah.
Okay,
cool.
When you're doing a cash flow question, this is just exam technique. You should actually start with the addition information. The reason why you do that is because of adjustments. Okay, so only for a cash flow, because this is a CC, okay, and it's indirect. Oh, hold on, I'm on the wrong one. It says direct here.
Different for a second.
I'm just looking. This says direct. Was it number 4 then?
I wonder if it was the question above this one or the one below it.
Was it 2?
See,
No, I don't think it was
no,
2.
it wasn't. It wasn't 2. Yeah.
It was
This one is
3. Was 3 direct or indirect? This looks like
That's
direct.
direct. It might be one more down then.
Then it must be 4. This one. Oh, here, indirect.
Indirect, yeah.
Okay, so is there a question above that?
No, it'll be below it.
Okay, there we go. All right, so it was 4. Okay, that's fine. Okay, so exercise 8.4. Okay. All right, so we need to start with the addition information. Okay. All right, it looks like a short one actually. There's not much addition information. It's actually just one page. Let me see if I can shrink it. Let's see if it can fit on this. Let's go 70. Okay. Yeah, there we go. That's all of it, hey? Yeah, that's all of it. Okay, so you've got there we go. Okay, I think what I'm going to do is I'm going to try split the screen. At least then I can have the question and the workings all together.
Cool.
Okay. All right, so there's your question and there's your template. All right, so a good exam technique would be to write down the template like what we've done, and then obviously go and look at the dish information. So the first thing I'd be looking at is the dish information. So they tell me that no machinery and equipment was purchased during the year. Machinery and equipment was sold for cash. Okay, so what are you thinking about when you see something like that? What are you thinking about? What should you be thinking about?
Machinery and equipment.
Operating, financing, or investing?
Investing.
Yes. Okay, so as soon as you see something like this, machinery and equipment, you know you're looking at investing activities. They tell you that no machinery and equipment was purchased during the year. All right, so under investing, I'm going to say no. If it's purchased, then there's no outflow from an acquisition of new PPE. Okay. Here they said machinery and equipment was sold for cash. So there is an inflow from the sale of machinery and equipment. The problem with this is you need to solve for the actual sale. In other words, this is an asset disposal. So in FAC 1502, you would have done an asset disposal. Okay, the best way to get the cash flow for an asset disposal is to draw up the T account for the asset disposal. Does it make sense?
Yeah.
Okay, let me just move this out of the way. Okay. All right, so debit side, credit side. Or we're going to need an extra line.
Sorry, it was an...
What's wrong?
No, it's just it was an inflow.
Okay, asset disposal is what's going to be the best option. With an asset disposal, remember, you're closing off the account. So for example, if I have machinery and equipment and I'm selling machinery and equipment is an asset. The asset will have a debit balance. To close off machinery and equipment, I would credit that account, then I would debit the asset disposal. So the cost would go there. Okay, if I've got an asset disposal and I'm closing off the accumulated depreciation, I'm going to have accumulated depreciation on that side. Okay, if there's a profit or a loss, that'll either be on this side or that side, depending on which one it is. Okay, so we need to look at the question and find a profit or loss. I see a loss on sale of machinery and equipment. Okay, so again, we're breaking it down to basics. So a loss on sale of machinery and equipment, in terms of its accounting elements, a loss on sale will be seen as an expense. If it's an expense, then an expense will have a debit balance. If it has a debit balance, you would have debited the loss on sale of equipment, and then you would have credited the asset disposal. Does that make sense?
Yeah.
Okay, so the loss on sale was how much? 500. Okay, that we've got there. Okay, if it's a loss on sale of machinery and equipment, I know, okay, that's a non, not a non, a non, non is fine, a non-cash item. Remember, any loss on sale is a non-cash item. That loss on sale, if it's a non-cash item, is that going to affect the income statement?
The income statement.
Does a loss on
Yes,
sale get disclosed in the income statement? Does a loss on sale get disclosed in the income statement? Yes or no?
No, I don't know. It doesn't go. I know it doesn't go into the cash.
It does get disclosed. Have a look. Here's the comprehensive income statement for the year, right?
It's on there. Sorry. Yeah.
So does the accountant record the loss on sale? Yes, they do. But remember, the accountant is accounting for things based on an accrual basis. Okay, we need to take the accrual basis and we need to relate it to cash. Does that make sense?
Yeah.
Okay, so when I'm looking at cash flow, right, this profit before tax, let's assume the profit before tax is 100. Okay? All right? If I have a loss on sale, the loss on sale means this profit before tax would be understated or overstated?
Overstated.
No, it'll be understated if there's a loss on sale. Loss on sale means you would have subtracted that loss on sale before calculating the profit before tax. Does that make sense?
Before that. Yeah.
So in order to get the cash flow, you're going to have to add it back. Does that logic make sense?
Yeah.
So you add back the loss on sale of an asset.
Machinery.
Okay, in this case, machinery and equipment. Can I write M and E? Is that all right?
No, that's fine.
Okay. All right. So any profit or loss on sale is seen as a non-cash item. Non-cash items need to be removed from the cash flow from operating activities because they would have been included as part of this calculation. Because remember, you have sales, cost of sales, then you have gross profit, then you have other income, other expenses. Okay, and then you have profit before tax. All right, so the profit before tax is 100, which is what I was saying earlier, and the sales was, let's just use 200, okay, and there was a loss on sale, and let's say the loss on sale was 10, okay. In order to get 100, I'm going to need 110 here. Okay, so then my cost of sales would have been 90. All right, so if you follow this basic working, all right, remember sales we're going to assume is all cash. Does that make sense?
Yeah.
Okay, so if sales is all cash, I know that I've sold 200 all cash. That's an inflow. Okay, all right, and then obviously the gross profit is 110. Okay, obviously cash, cost of sales we can say with purchases, and we can say that's all cash. Okay, so then your cash flow in terms of inflow would be sitting at 110. Do you agree?
Yeah.
Okay, that's the inflow. But when I'm looking at profit before tax is here, and that's only showing 100. So is that over or understated? It's understated. Do you see that?
Understated, yeah.
That's why you're adding this back, because you're removing it. You're taking it out because you're removing the accruals. Okay, do you see the logic?
Yeah.
Okay, and that's why when I'm looking at a question like this, I'm trying to adjust profit before tax for the accruals to get what I actually have. Okay. Make sense?
Yeah.
Okay, so this loss that I'm going to add back is how much? 500. Okay.
Yeah.
Then I need to go to my asset disposal and I need to look at the balances. Okay, so I need to get an amount. Okay, machinery and equipment, I need another T account. Do they give me accumulated depreciation? Yes, they do. Accumulated depreciation. All right, so accumulated depreciation was what? Let's check it here. 43 and 49.
Okay.
Okay, so 49 was the opening balance.
Yeah. Why would it go down?
Because you sold assets.
Oh, right. Okay.
Okay, when you sell an asset, you get rid of its accumulated depreciation as well as its
Right. Yeah.
cost.
As it's costing.
Okay, so when you're doing cash flow is all about T accounts. All right, because this is an asset, you'll have a balance there. We'll have a balance brought down and a balance carried down. Okay, so under accumulated depreciation, 20.4 was 49, and then closing was 43. Okay, do I have depreciation for the year? Yes, I do. Depreciation for the year is 19. Depreciation is an expense, so you would debit the depreciation and you would credit accumulated depreciation. Does that make sense?
Yeah.
Okay, that's from 1502. Okay, and then you would have shown how much depreciation? 19,000. All right, so 19,000 depreciation. Okay, when you have an asset disposal, we just spoke about accumulated depreciation here, it's going to be written off. So if I'm crediting this account, I'm going to be debiting that account. Does that make sense?
Yeah.
Asset disposal, right? Okay, so what is the balancing figure? We can work it out. Okay, so I'm going to sum up this. Okay, I'm going to work out that. And this balancing figure is what I'm going to solve for. Does that make sense?
Yeah. Yeah.
Okay, so it's basically incomplete records. You're basically trying to find missing figures in order to determine what the proceeds were from the sale of the machinery and equipment. Okay, let's go look at the machinery equipment. Machinery equipment, what is the balance? The cost was 220,500, which was the opening. The closing was 17. 177. Okay, what else do we have? Okay, the question said no machinery and equipment was purchased during the year, so we don't have any additions. Machinery and equipment was sold for cash, so we do have an asset disposal. Make sense?
Yeah.
Okay, so looking at this, that side is bigger. So if I balance off this account, the asset disposal figure is this minus that. Which gives me 43. All right, so now I can wrap up and I can look at this asset disposal, okay, to determine what the actual proceeds were from the sale of an asset. Does that make sense?
Yeah, I'm following.
Okay, so if I'm looking at this, which one is the biggest? This is the biggest one, 43,000. Okay, this is
25,500.
Yeah, that's smaller, right?
Yeah.
Okay, so that means 43 is the biggest. Okay, so bank would have increased. Bank would have increased by how much?
what's that? 18,500.
18,000.
18. Yeah.
Does it make sense?
Yeah, got it.
Okay, and that's what you're doing in terms of cash flow. You're looking for cash. All right, this is inflow. Remember, if you're going to be crediting asset disposal, you'll be debiting bank. So if you're debiting bank, you're increasing the bank. So the bank would have gone up. Does it make sense?
Yeah.
Okay, so that would have gone to operating, financing, or investing. That's part of investing. So inflow from the sale of machinery and equipment. There we go. I'm going to reference that working. 18,000. Does that make sense?
Yeah. Yeah.
Okay. All right. Was there anything else in this question relating to machinery equipment? No. All right. Next, inventory is disclosed at cost. All right. What is inventory looking at? You tell me.
Operating.
Why?
Because it's your day-to-day. It's where you get your sales, where you do your sales from.
Basically, yes. So if you're looking at your operating activities, profit before tax will be affected by any adjustments in your inventory. So in order to show that, I'm going to drop a T account for inventory. Okay, inventory is the T account that I need to use to disclose the amount of stock that I have. So what is my opening closing stock? I need to look at it at the question. It looks like 31,050, eh? So started at 50, ended at 31.
Yeah.
Okay, so when I look at inventory, okay, 31,000. All right. Remember, inventory is going to have an amount that's going to represent a purchase. Do you agree? Those purchases are going to affect who?
It's an outflow. You. Or is that what you mean?
Yeah, in other words, so for example, let me explain it this way. When you're looking at this account, okay, which side is bigger here?
The left.
The left-hand side. Okay, so your debit side is bigger than the right-hand side. So if I'm looking at the balance, okay, what am I actually doing? I'm going to be representing, well, not representing, but showing the movement in inventory when I make purchases. So I need to do this.
Yeah.
And I need to show the accounts payable, trade payables. All right, because trade payables is going to affect inventory. Okay, they said inventory is disclosed at cost. Okay, inventory is disclosed at cost. So I know what it costs. 50 was what I started with. 31 is what I ended with. Okay, but obviously a certain amount is sold. So inventory will have cost of sales. Okay, and inventory will also have purchases. Okay, cash or credit depending. All right, in your trade payables, okay, will there be a payment here?
No, because it reduces.
There will be a payment for trade payables. Okay, remember you pay your creditors, don't you?
Yeah, I'm just trying to work out. I'm trying to think like between the years.
Ooh, hold on. I've got the wrong way around here. I need a liability. There we go. Okay, I need a negative asset or liability. The balances are the wrong side here. Let me just fix that quickly. Okay. All right, let's continue. Okay, so I was just referring to the inventory and the trade payables. Okay, so with trade payables, we needed a liability, okay, in terms of balances. So we'll have opening and closing balances here. Okay, the trade payables was 13 and 25, I see here, hey?
Yeah.
Okay, so started at 25, ended at 13. Okay, so if we're looking at the actual balances that have changed, okay, if I'm looking at inventory has decreased. Okay, it didn't increase. It was 50 and now it's 31. Okay, here you've got
Yeah.
trade payables. Trade payables was 25 and now it's 13. All right, I've got purchases here. Okay, so we're looking at cash flow. The difference here in terms of bank will be how much you've paid. All right, so if I'm looking at inventory, did they give you cost of sales? No, they didn't. So you can't use cost of sales here. You wouldn't be able to draw cost of sales. Purchases, you could work out the difference, but the difference will be 50
Negative.
minus, okay, yeah. All right, so I think because this is indirect, you can't recreate the T account for inventory because you're missing information here. I see this isn't complete. If this was complete, you'd be able to recreate the inventory account because you'll need cost of sales here. All right, so you won't be able to work out inventory, but if you're looking at the adjustments, if we think about it, if we're looking at our disclosure, we need to provide for changes in our current assets. Okay, so let's think about this. If I increase my inventory, that means I've purchased more. Would you agree with that?
Yeah.
Okay, so if the balance goes up, that means I have a cash outflow because I've purchased more. If inventory decreases, okay, is that an inflow or an outflow?
It's an inflow.
That would be seen as an inflow. Decrease in inventory
Yeah.
would be seen as an inflow because you've sold more. Yes, that would make sense. Okay, all right, so you would have to add the decrease in inventory, because that would affect your profit before tax. All right, because if I increase inventory, that would be seen as a purchase. That's an outflow. This would be seen as an inflow because stock has been sold. If stock is sold, that means I've received more cash. So what is the total here? What's the
19.
difference? 50
19,000.
minus 31
Yeah.
gives you 19. Okay, that's fine. All right, let's go back to this one. Okay, trade payables. I don't have purchases. Okay, so I can assume that there has been a change in my balance. Okay, because there's no information for inventory. Okay, I need to look at my trade payables. Okay, if my trade payables are 25,000 opening balance and my balance decreased, let's think about this. Okay, the balance decreased, so
It's
would
an
that have been a
outflow.
payment or a receipt?
It's a payment.
That would have been a payment. So inflow, outflow.
Outflow.
That would have been an outflow. Okay, so bank would have been credited, payables would have been debited, so that's fine. 25 minus
13. 12.
13. Okay.
I think I did it wrong there. There we go. Yeah. Cool.
Yeah, but yeah, there's a bit of missing information here, so it's not quite right because obviously you'd expect to see more in the T account for trade payables. But if we're just understanding the principle, obviously I'm looking at a payment because remember there will always be a bank line item here. Does that make sense?
Yeah.
Okay, in your trade payables, you would always expect to see bank debited, bank credit, while trade payables debit and bank will be credited. In other words, you're going to be reducing your cash flow. Does that make sense?
Yeah, makes sense.
Okay, so that would have been an outflow from a decrease.
I think are you on the right place? Investing activities.
Investing. Oops, yeah, you're right.
I think the machinery one is in the right place though, isn't it?
Yeah, just copy that bit. Okay, so outflow from a decrease in trade payables. Okay.
Cool, yeah, got it.
All right, the trade payables figure we calculated here, that figure was 12. Okay.
Alrighty.
All right, let's see what else we've got here. Next, okay, so inventory we've looked at. The inventory will affect our trade payables. We've looked at that as well. Okay, the next one is a fixed deposit. A fixed deposit was redeemed in cash during the financial year. Okay, if it's redeemed means it was basically, it matured. So when a fixed deposit matures, do you receive cash or do you pay cash? Which one?
It's an inflow.
You receive cash. Correct. This would be financing because it's a fixed deposit.
Financing or investing?
Investing. Sorry, I said financing.
Investing. Okay,
I'm
cool.
right. Yeah, investing because it's a long-term asset. Yeah. Any
Yeah, makes
long-term
sense.
asset
Okay,
is
cool.
investing. Does it make sense?
Yeah, with you.
Okay. Maturity of the fixed deposit. Let's look at the fixed deposit. What was it? It was 50 and then 35. So that means we would have received the difference. Does that make sense?
Yeah.
Okay, gives me 15. Okay, all right. Next point. The interest on the long-term loan is not capitalized. If it's not capitalized, you're going to have interest paid here. Okay, and then we need to draw up the interest account. Interest on, what is this? A loan.
Long-term loan. I think it's fine.
Okay.
Yeah, long-term loan.
Okay, so we need to look at our income statement. Our income statement is going to show the accrual. So the interest on long-term loan is showing 14,000. So that would have gone to profit and loss. Do you agree?
Yeah.
So the profit and loss figure was 14. Okay. There might be a balance here. There might be accruals, but the bank portion is going to be there. We need to know how much we've paid. Does that make sense?
Yeah.
Okay, was there an accrual for the interest? The interest on long-term loan is not capitalized. Not capitalized means it's separate. So let's see, in our list of balances, do we see any accruals for interest? Interest payable. There's one, hey? Do you see that?
Yeah. Yeah.
Okay, so if interest is payable, payable means liability.
Yeah.
Okay, so interest payable. What was it? It was 6,000 at the beginning. And it's 5,000 at the
5,000.
end. Does that make sense?
Yeah.
Okay, so the difference would have been what? It would have been
The
1,000
1,000
on this side. Do you agree?
to bank, yeah. Or not?
That would have been an accrual.
Right. And then that goes to bank. Okay, got it.
Okay, that would have been an accrual. It's basically accrued interest. Does that make sense?
Yeah.
Accrued interest expense. Happy with that?
Yeah.
Okay. All right. So that is going to be 15. 15. So the amount that you paid was 15. Does that make sense?
Yeah.
I'm looking for the balancing figure.
Oh, right. Of course. Yeah. Sorry. So
Bang.
it's the interest that said you paid plus the
Plus the
accrued
accrued
interest.
interest. The accrued interest is interest that I haven't paid yet. Does it make sense?
Yeah.
Okay, so interest paid here comes from my working. My working gave me an answer of 15,000. Okay. All right. The
Right.
last point says there was no other comprehensive income for the year. Okay, that's fine. That's just additional information. All right. Then I need to go back. Then I need to look at each of these line items. Share capital. Did it change? No. Preference shares, it
No.
didn't change. Retained earnings did change. I need to do a working for that. Retained earnings is seen as an equity line item, so you would have a credit balance. So I'm going to need something that looks like this. Okay, so the retained earnings tells me what profit is happening in that particular business. All right, so if I'm looking at retained earnings, I'm going to be focusing on any possible payment or distribution. Does that make sense?
Yeah.
Okay, so when I'm looking at retained earnings, I need to look at the balance. What was the balance? I'm seeing
15.
15 and 48.
48. Yeah.
Okay. All right, now we need to think. What can affect retained earnings? Profit. Profit will add to retained earnings.
Yeah.
Okay. If you prefer, you might want to do retained earnings in the SOCI. I don't know if you are aware of that. In the SOCI, the statement of changes in equity, I think we did this last week even, where we looked at opening balance,
Yeah.
closing balance, and then you had movements in between. You had profit, you had dividends, and so on. Does that make sense?
Yeah.
Okay, but that was for a company. This is what? A CC. If it's a CC, CCs can pay dividends, but it'll be a distribution to the members. Is this a CC or is this a company? Well, I
I
can't
mean, the
remember which one this was
share
for.
capital. It said it was a CC,
Oh,
but
it's
the share
a
capital,
share
so it
capital, so it
must be
must
a
be a
company.
company.
Yeah.
Okay. All right, so you can do it that way if you prefer, and then you can look at the SOCI. Does that make sense?
Yeah.
All right, so what is the profit for the year? The profit for the year was 70,500. Okay. That's the profit for the year. That's the retained earnings. Okay. With retained earnings, there's also going to be a distribution. So when I'm looking at profit, I also need to look at dividends. Okay. Okay. Do we have dividends? We should. Let's look at the question.
It's the third block on that page.
Yes, they're dividends. Okay, and you've also got dividends payable there, I see. So we've got a liability. Yeah, you would expect to see dividends, shareholders for dividends. Let me actually rename these. Shareholder for dividends would be the liability. Here they talked about dividends payable. And then you'll have dividends paid or dividends expense. Okay, so let's see. What is the dividends payable? We've got 37,500. And 15,000. All right. How much dividends did you declare? Ordinary and preference, 30,000 plus 7,000. So you've got preference and you've got ordinary. So I'm just going to group them as one. This will be dividends payable. And I'm just going to add the two figures together, the 30 plus the 7.5. Does that make sense?
Yeah.
Happy with that?
Yeah, we're good.
Okay. All right. And then we're trying to determine how much dividends we've actually paid. So we need to now consider the T account. There'll be a bank amount here because dividends have to be paid. So I can balance this off. So I know how much I've paid. Okay, dividends payable. The bank figure is representing the amount of dividends that was paid. So if I go back to my disclosure, I can add that here. Dividends paid equals my working. $60,000. Does that make sense?
Yeah. Yeah.
Okay. All right. Let's see. What else do I need? We read the last point. Okay, we spoke about dividends. Retained earnings. There won't be any bank figure in retained earnings because retained earnings, a portion will be paid out in the form of a dividend and the rest will be retained. Does that make sense?
Yeah.
Okay, so there's no need to balance that off. Let's go back. Okay, long-term loan we looked at. No, we didn't. We looked at the interest. We didn't look at the long-term loan. Okay, the loan went up or down?
Down.
Inflow, outflow?
Outflow.
Good. Okay, you pay off your loans. That'll be financing.
Yeah. Okay. Yeah.
Okay, what is the difference? Okay, that's easy to calculate. 100 minus 70 is 30, right?
Yeah.
Okay, be careful though. Put a minus here. Okay, is that all right?
That's fine. Yeah.
Okay.
Actually, with regards to that minus, I just had one question, and it's just a little bit up on your sheet in the operating.
Yeah.
And yeah, it's so there where we say we add the decrease in inventory, but
add the O. Add back.
Add back
the decrease in inventory. So basically, it's a this was a.
Oh, right. Sorry, I'm following now.
Yeah. So if you're adding it back, it's a cash flow.
Yeah.
It's inflow. Does that make sense?
Yes. Yeah.
Okay, it's an inflow.
Yeah, it was decreased,
okay.
Right. Okay. Yeah. Then
All
I've got it. Okay.
Land and buildings. Have we looked at it? No. Did land and buildings change? No, it stayed the same. Machinery we looked at. Fixed deposit we looked at. Inventory we looked at. Trade receivables we haven't looked at. Okay, so let's think about it. Trade receivables, that would be seen as an asset. But I can't draw that up for receivables. So there we've got payables. Receivables, you can't show the sale, so you won't be able to show all of it. You can show some of it, so maybe we can put what we can. At least then you've got it, because then if you have a different question, you would still do the same thing. Okay, so I'm looking for the movement in terms of cash flow. All right, so my trade receivables. Sean, you still there?
Yeah, I'm here.
Okay, it's quiet, so I just thought maybe I might have lost connection, but it's fine.
No,
Okay.
all good. Sorry, just
All right.
listening.
No, it's okay. Trade receivables, what is it? 35 and 30.
Yeah.
Okay, so also in trade receivables, you would expect to see sales on this side. Do you agree?
Yeah.
And then you would expect to see bank on this side. Okay, bank would be going up, so you debit the bank and credit the receivables. So because we don't have cost of sales and sales in this question, we can't recreate this whole account, but we can look at parts of it. So we would assume that there was a 5,000 receipt. Does that make sense? Is a receipt an inflow or an outflow?
It's an inflow.
It's an inflow, correct. Okay, so
Yeah.
this would affect our operating activities. Does that make sense?
Yeah.
Okay. All right, so okay, and that amount is equal to the working we had here. All right, bank we need to look at. Bank will be right at the bottom. Okay, so the bank balance opening, what is the opening? Opening, okay, this is the closing. This is 47. This was 2015. 2015 is closing, and it was a debit balance. It was 47,000. Okay, we need bank overdraft. Okay, there's bank overdraft. It was 2,000. Overdraft, so it's a negative balance. Do you agree?
Yeah.
So going from an opening balance of -2 to a closing balance of 47, the net cash flow would have been 49 plus. Do you agree?
Yeah.
Okay, because you would have to have brought in 49,000 to offset the overdraft to increase the bank balance to a favorable amount. Unfavorable to favorable.
Yeah.
Does that make sense?
Yeah, it does.
Okay, so that's 49. All right. Next. Okay, prepaid rent expense. Because this is a prepaid expense, remember prepaid expense is a current asset. Do you agree?
Yeah.
Okay, this is going to be an adjustment because this would be seen as a non-cash item. Okay, so let's think about this. If the prepaid expense did it go up or down? It went down.
Down.
Okay, so if it went down, how would a prepaid expense decrease? A prepaid expense would decrease. If it's a prepaid expense, that means it was prepaid. So you paid it this year. So it would have been an outflow. So you have to add it back. Does that make sense?
Yeah.
Okay. So we need to add back the prepaid expense. Make sense?
Just a quick question. If
Yeah.
it's cash flow, the actual cash would have been paid in the previous. Because if it's prepaid, then you've already paid
so
that
okay,
expense.
if it's prepaid, remember prepaid is 2014. 2014 prepaid. Okay, let me show it to you like this rather. I think this might make more sense. What is it? Prepaid rent.
Rent, yeah.
Okay, if it's a prepaid rent, it's a asset. Do you agree?
Yeah.
3,000 at the beginning, and then 0 at the end, right?
Yeah.
Okay, obviously you're gonna have rent expense. And that rent expense would be for the period, right?
Yeah.
Okay, so what was the rent expense for the current year? That would have gone to profit and loss. The rent expense, did they give you that in the question? Oh no, they didn't. See, you can't draw this out.
So, yeah.
Yeah, unfortunately. Okay, but yeah, let me just talk it through then. Okay, so prepaid rent. This was prepaid. Prepaid means you paid for it last year. Does that make sense?
Yes.
Okay, if you paid for it last year, you're paying for this year's rent. Does that make sense?
Yeah.
Okay, so is this year's rent over or understated?
Understated.
Why do you say understated?
Because it would show that we owe less.
Remember, it's prepaid. If it's prepaid, what does that mean? Prepaid. Okay, so think about it. Last year, let's look at the dates. In 2014, you prepaid rent. That means you paid rent. So that's an outflow. The outflow is going to affect next year's rent. Do you agree? So
Okay, I see.
next
So it's
year's
actually going
rent,
to inflate. It'll
next
inflate
year's
the.
rent will be for 12 months, right? That
Yeah.
will be the accrual. What is the accountant going to show? The accountant is going to show 12 months worth of rent. Are you going to pay 12 months worth of rent?
No.
No, you're only going to pay maybe 8 months or 9 months, whatever the case might be.
Yeah.
Okay, so this year you pay less. Do you agree?
Yes. Yeah.
So if you're paying less this year, but remember your rent is an accrual, so the rent is actually overstated because if you think about it, okay, in this line item, profit before tax, this profit before tax, is that going to be taking 12 months worth of rent or 9 months worth of rent?
12.
12 months. So you have to add back
Yeah. Add back that. Okay.
the
The
prepaid rent for this year.
Got it. Okay.
Does it make sense? Like in terms of cash flow?
Yeah. 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 Got it.
Okay. All right. So what was the amount?
3,000.
Was it 3, hey? Yeah. Okay, there's
Yeah.
it there. 3,000, yeah. Okay, happy with that.
Yeah.
Okay. Next, what do we have? Trade payables we looked at, bank overdraft we looked at, current tax payable we need to look at. Okay, that means we're gonna have tax here. Okay, this requires a T account. We need a liability type account. Ooh, I don't know why that paused. Sorry. I think we might have missed some. I'm just checking. Okay.
It's all good. I've got at least the sheet is there. So
Yeah, no, I think I pressed the button that paused it, but it's fine. It recorded an hour and 7 minutes. How long have we been going for? Probably about an hour and seven. Yeah. Okay, I don't know what happened there because when I see a mark appear, then I know the recording stopped. Okay, so it's fine. I think we got everything. It's fine. Okay, interest received. What did we say it was?
13.
Fixed deposit 13. Okay. Oh, I need to put negatives here, hey? Be careful. Be careful. Tax paid, dividends paid. I'm just looking at what I've done here. Interest paid, those are all negatives, eh?
Okay. Yeah.
Okay. All right, interest received, positive, that's good. All right, depreciation, you always have to add that back. Why do you have to add it back? Think about it. It's a non-cash item, do you agree?
Yeah.
Non-cash items get added back. How much is the depreciation? 19.
19. Yeah.
Okay, loss on sale of that I did already look at. There's the loss. We add back the non-cash. Interest on long-term loan. We've got the interest. Tax we've got. Profit we don't have. We need to show that. Profit for the year. Okay, profit before tax is profit for the year. Add back the tax. Does that make sense?
Yeah.
Okay, so profit for the year. Add back tax. Okay, so how much is that going to be? Let's see. What is the profit for the year? 7,500. Add back. Tax of how much? 43.
41.
43. I see 43 here.
Not the tax paid. Actual tax expense. Yeah.
Okay, remember the tax expense is an accrual. All of this is an accrual. Profit before tax, profit after tax, those are accruals. That's what the accountant is looking at. Remember? Okay,
Yeah.
the accountant is going to show that on the income statement. There, that's what they're showing on the income statement. Tax, income tax expense, profit for the year. So maybe let me show you this. Okay, the accountant would have had profit before tax, less tax, and then profit for the year. Make sense?
Yeah.
So if they've got 7,500 here, and they've got minus 43 there, obviously this is going to be the missing figure. Does that make sense?
Yeah, I got you.
Okay. All right. Dividends
I
we
was
looked at. Okay,
adding.
we've looked at everything. Is that all right?
Yeah.
Okay,
Yeah,
let's
that's
add up
good.
all the
It's
adjustments.
a lot.
Let's see what we get. Okay, cash generated from operations. We're summing up. We're wrapping up. We're seeing what we've got. Okay, I've got that figure. Add back plus. Inflow, add back plus. Outflow minus. Inflow plus. Add back prepaid rent, add back depreciation. Does that make sense?
Yeah.
Is that all right?
Yeah, I'm with you. Okay, cool.
Okay. Then we have operating activities. $48 minus plus gives me 45. Is that all right?
Yeah.
Okay.
Great. Okay.
This one, all inflows, eh?
Yeah.
Okay, gives me that. And then this is just the same figure.
Yeah. Okay. Cool.
Ah. There we go.
All right.
Okay, let's check if we're right. Okay, operating plus investing plus financing equals operating, operating plus investing plus financing equals 48. Ooh, I'm 1,000 out. Is there answers for this?
There should be solutions further down.
Let's see.
Usually just below it. There we go. Solution.
Okay, I see they've done different calculations. Okay, here's the answer. Okay, the 113 is fine. The 5 is fine. The 19 is fine. Oh, interest income, fixed deposits. I see they've got it here as an adjustment. Oh, okay. Yeah, because interest received. Okay, they've shown it here. Okay, that's something that you do need to take into consideration. Remember, the interest received is part of your profit before tax. Does that make sense?
Yes.
Okay, so you can't show interest received here, okay, if you haven't taken out there. Does that make sense?
Yes.
Okay, so yeah, we do need to take that into consideration. That's just disclosure. All right, so add back, not add back, subtract, minus. The interest income, that's the accrual. That's just disclosure. Okay, so yeah, in terms of disclosure, I haven't got that. That is definitely something that you would have to consider.
Okay.
Just in terms of disclosure, so you would have minus 13 there. Okay. All right, so there's the minus 13. Okay, decrease in inventory. Do we have the decrease in inventory?
Yes. It's the second inflow there.
Decrease in inventory. There's it. No.
One. Yeah.
Yeah, that is the inventory. Yeah, there's the 19.
Yeah, that's it. Yeah.
There's the 19. That's fine. The trade receivables, we've got the 5, we've got the 3. Okay, here's 12 here. Decrease in trade payables. Did I make a mistake here?
There's the decrease in trade payables. It's the fourth.
Oh, there's at the
third line
top.
in
So
that.
I'm looking at the 13. Okay, so what do we get now?
But we don't have it as a decrease.
Hold on. I think I made a mistake with the totaling. Okay, add back the profit on sale. Okay, let's just check this working. I've added there. I've subtracted. I think the add back the loss on sale. Did I add or did I subtract? I did add. Yeah, I did add.
I think the decrease in trade payables, they showed as a decrease, and we've got it there as a positive. We've added it.
Trade payables.
That one.
Trade payables is 12. They've got it as a minus 12. Outflow is fine. It's 12. Okay, but here I did subtract it. Did I subtract it? No, I didn't. No, I did. There's it there. Subtract.
H9. Oh, right. Okay.
Yeah, I did subtract.
Okay, cool.
Then I added inflow. Then I added. Yeah, I did add back.
All seems right. They just don't have the.
Oh, then I just need to less the interest income plus this one. Remember, we had to add that one. Up at least, then we've covered it, so it's easier just to do it like this. I don't mind, so okay. Let's carry on and let's just look at it. So the 13's there, the 14, this 14 interest on long-term loan, I see I don't have that. Okay, that interest on long-term loan, again, it's an accrual. Okay, so if you look at this working, I've left out the accruals. All right, because remember, in the profit before tax.
Sorry to interrupt you, Anthony. You did have it just below the cash generated. You've got it in interest paid. So you've also got to have it just above there. You've got it there, yeah. You've got that plus the 1,000.
Hold on, what are you looking at?
Yeah, that. I'm looking at that.
Interest paid, all of this is correct because that's the actual cash flow. Remember, this is disclosure in terms of the accruals, because have a look at this. If I've got interest paid here, I can't show it here in the profit before tax as well.
Yes, yeah.
Because remember, profit before tax already has taken out the interest paid because the accountant would have shown it. Does that make sense?
Yeah.
Okay, that's why that's disclosure. Add back the interest expense. That's the accrual because of disclosure. Because if I don't add it back and I take it out there, I'm taking it out twice because it's already subtracted from the profit before tax.
Yeah.
Do you see that? Okay, so yeah, the disclosure is what I've missed here, and that's the problem. That's why I didn't balance nicely. Okay, so if you've got the 14 here, okay, and then I add another 14 there, that's going to give us the 149. Then the rest should be fine.
Okay.
Yeah, 49,000. Operating, financing, and investing all add up to the right amount. Do you see that?
Yeah.
Okay. All right. So just be careful with that disclosure. It was something that I overlooked because the profit before tax already takes the interest into consideration. So you can't take it off twice. If I have it here, if I pay interest and I receive interest, I'm showing it, I'm disclosing it here, so I can't include it there. Does that make sense?
Yeah.
Okay. So yeah, you just need to take it out so you don't double account for it.
Okay.
All right. Is that all right? Does that make sense?
Yeah, this helped a ton.
Okay, perfect. All right, so I'm going to stop the video here.